¿Te parece, Jorge, que comencemos?
Cuando quieras,
Genial.
adelante.
Well, I'll speak in English because our speaker of tonight is an English speaker. So, well, firstly, my name is Federico Fernandez. Thank you all for joining us this afternoon or this evening, depending where you are, for this very interesting talk that we are going to have. Just a few quick remarks before I give the floor to Dr. Nakhle. Firstly, thanking Carole for the talk she's going to give us. Thank Club de la Libertad and Fundación Cívico Republicana for co-organizing this with Somos Innovación and Fundación Bases. Thank you particularly to Jorge and to Alberto and to Rodolfo for all the effort and all the help they put in this to organize it. And also thanks to some of the Somos Innovación partners like Instituto Ciencia Política of Colombia, who also helped us promote, and they were very interesting. Some of them should be with us today. Today we are kickstarting a series of events. Most of them will be in Spanish, but you know we wanted, let's say, to have this little treat to begin with, and it had to be in English, but it's a very interesting talk, so we're happy to have it. A series on innovation, co-organized by Fundación Cívico Republicana, Club de la Libertad, and Somos Innovación. We think it's great to be able to have some time to discuss not only day-to-day issues, but also some, you know, a bigger picture, some issues that have an impact not only today, but in the future and in the near future. Particularly, innovation is having a deep impact in our lives. I mean, this what we are doing today, let's say, it testifies that. So we think it's great to be able to have an hour or so every month to discuss these issues that go beyond day to day. And in that regard, as I was saying, we are extremely happy to have Dr. Carole Nakhle with us to give the first talk of this series. She's going to be talking about the energy market. I'll introduce her very briefly. Sorry, I butchered her CV. You can find both on our websites and at Crystol Energy, her company, her full CV. But just let me quickly tell you that Dr. Carole Nakhle is the founder and CEO of Crystol Energy. She's been awarded the best, Crystol Energy has been awarded the best independent energy consultancy of the UK in 2018. She's from Lebanon. I don't know if you know, Carole, but in Argentina, we have a significant community of people with Lebanese origins. She's been recognized as an international authority on global energy issues, in particularly in oil and gas markets. She teaches at the Blavatnik School of Government at Oxford University and at the University of Surrey. And she's the founder of a not-for-profit organization called Access for Women in Energy, which she started in 2007. And last but not least, she writes at least once a month for the Geopolitical Intelligence Services founded by Prince Michael of Liechtenstein, which is how we found about her work, and we read her columns religiously. She will be speaking for about 25-30 minutes, and then we really encourage you to leave on the chat or your questions, so we can have some Q&A session after her initial remarks. Without further delay, Carole, the floor is yours, and thank you again for being with us today.
Thank you very much, Federico, for this kind introduction and for actually having me with you. I would have loved to show you the majestic Black Forest in Germany, where I am at the moment, but it's just after 9 p.m. So there isn't much for you to see except this boring background behind me. But I'm usually based in the UK. However, Because of COVID, I've been a nomad. First, we got stranded in Abu Dhabi, where we're spending some holiday time with the family. And then we got stranded here in Germany, and really no idea when we would go back to the UK. But this kind of reflect, I think, the overall sentiment, not just on me personally, on everybody else, but also when it comes to energy markets, particularly oil markets, and the global economy. There are still big question marks about the direction they are taking. I took the liberty to modify the title because I am going to cover issues such as the energy transition, but I thought that let's look at where the markets are heading, what has happened, because COVID has been a shock like no other in the modern times of the energy industry and the global economy, and it's not over yet. It must have created some scars that will stay with us for many years to come. And before the pandemic hit, many people were talking about the post-fossil fuels and especially post-oil age. Now, actually, the discussion has accelerated, and people think that COVID-19 has indeed accelerated the energy transition. But before we jump into mixing all these topics, we have to look at the issues in different time frames. So we have the immediate market developments with major implications on producers, private companies, state-owned companies alike. And there is also the longer-term outlook, because the longer-term outlook will determine the investment trend today. So it's not just only oil prices, it's also where the industry sees itself in the coming years. So I'm going to cover a few things. So first of all, just have a quick snapshot at what are the problems caused by COVID-19, first in terms of the impact on the global economy, and in turn, the impact on oil markets. Check what are the main challenges facing producers, then take a longer term peek into the topic of peak oil demand, because if you talk about the energy transition accelerating, then this would equate a peaking in oil demand, where oil demand would stop growing and then start to decline, and with it the whole market shrinks. And then at the end, despite all the pessimism that we are surrounded with courtesy of COVID, I want to highlight perhaps some areas of optimism. That's why I call them silver lining, where we can look at the crisis in a different way. So this is really the main outline I want to go through with you. Let's start first quickly by looking at what happened. What we saw when COVID hit almost actually a year ago, almost exactly a year ago, what we had first the pandemic hitting. It started in Asia, but then it spread to the rest of the world. And with it, it really sent the global economy in coma, because that said, there was no more activity, much activity happening around. People were asked to stay home. Shops were shut down, restaurants were shut down, planes stopped flying. And as a result, we saw the impact on oil demand, which also was curtailed significantly. Federico earlier used the word butchered, and I'm going to use it exactly here, because that's what you had. You had a massive hit caused by the pandemic affecting the economy, and in return, oil demand. So we have had this kind of unilateral direction from the pandemic to the economy to the oil market. It is still there, but it may be weakening, because when you have a shock, after a while, what we call as economists, we call the path-dependent concept, you may create new paths that no conventional models can really forecast accurately, because it creates a completely new kind of sets of conditions. But let's look at the economy first. I call the crisis like no other, to quote the IMF, but I would also add a recovery like no other, because if you look at this in 2019, and here I picked the main regions in the world, world economy, US economy in green, the Euro area, and then Chinese economy. And you can see the massive hit that everyone took, except maybe China, because China managed to kind of get the pandemic under control before other countries, because it started there earlier by a few months than the rest of the world. But I mean, look at the Euro area, according to the IMF, more than -7% of economic growth, or actually shrinking. But then when you look at 2021, you see a much rosier picture. Of course, all these numbers are impressive, but we have to remember that we are starting from a very low base. So we have to put these numbers into perspective. But there seems to be a general agreement that both the Chinese economy and the US economies are going to rebound the strongest from this year from the crisis. And the OECD a few days ago, they published a revised outlook whereby they doubled their forecast for the US economy after the passing of the fiscal stimulus, COVID-19 relief package of $1.9 trillion that the new administration, the Biden administration has managed to get through. And as a result, they felt that not only the US economy is going to benefit, but there will be positive spillovers effect for the rest of the world, especially with the trading partners of the US, including North America and the Euro area. Now, here is the interesting part. When people talk today about commodity super cycle, and if you look at the forecasting agencies, especially the financial institutions such as banks, they are telling us to brace ourselves for any significant increase in prices for all commodities, whether metals, minerals, etc., but also oil. And they use the following to justify this kind of forthcoming super cycle. Whether it happens or not, we have to wait and see. But let me show you something which is really mind-blowing. Everybody seems to be expecting the economy to come back. Let's say there's this expression, roaring back with vengeance in around the summer area, which is the holiday time. And they use the following as a justification. First of all, around the pandemic time, because of fiscal stimulus and the support that people got from governments around the world, their personal income, ironically, on aggregate level, increased. At the same time, they were spending less. I mean, I was telling my husband a few months ago that ironically, I feel wealthier than before because I'm not going shopping. I hardly spend any money. So spending has been curtailed. And as a result, the saving rate has reached record levels. And here I'm referring primarily to data from the US, but the picture is not any different in the Euro area where I looked at the data. So we are seeing massive saving rates. And as a result, when people are expecting that hopefully by the summer, and I really hope that will be the case, the pandemic, the COVID-19 will be under control, at least in this part of the world. And as a result, people are going to spend all these, not all these savings, but a good chunk of their savings big time. And this explains why people are quite optimistic and excited about their outlook for this fourth quarter and the third quarter of this year. Now, you may share their optimism or not, but you know, I remain skeptical because I don't think the pandemic is under control. But we can leave that for the discussion. But at least there is ground for this kind of optimism and expectations about everything booming around the summer or towards the end of the year. Mind you, though, remember that last year everybody was expecting a V-shaped recovery by the summer, and it did not happen. What worries me, however, and here we're going to shift a little bit from the short term to the longer term when we talk about the economy, is the following picture. If you look around the world, and here I looked at the aggregate debt levels for corporate, for government, for household, you can see that everybody seems to be facing massive debts. And if you look at the money printing in the US around the pandemic, what they printed in 1 year in terms of money, it took them 25 years to do so in the past. So there's a lot of money circulating in the economy. And this by itself is raising some alarm bells. So we see some renowned economists, even, for example, in the US, some typical Democrats, such as, for example, Larry Summers, he published an article, I think, a month ago, warning of inflation. So yes, we may have this kind of boost in the short term, but if you know things go out of control, there is a structural problem of inflation, and as a result, negative repercussions on economic growth. So that's something to bear in mind because of this reality. And that's why we see central bank governors, they are going around and they're trying to calm investors and markets. But you will have perhaps an understanding because of this. You have two extreme scenarios awaiting for us. Last year, we had a kind of corridor, a limited corridor of expectations. When do we go back to pre-COVID levels? Today, the two main extreme expectations, the gap between them has widened significantly. So some people are expecting a boom in the summer, others are fearing inflation, and between them, expectations are varying. And that's what we're seeing in the market with this volatility. And you can see it in the stock market. You can also see it in oil price movement. But again, you know, this is just to give you some food for thought in terms of the impact of the pandemic on the economy. So it's not going to be over quite yet, even if we keep the pandemic under control. Let me now zoom into on oil markets. So again, just like at the economy, you can see that oil demand was hit very hard. I mean, there were all sectors in the economy, most of them were hit hard, but the service sector, the hospitality, the energy sector in particular, oil and gas, were hit severely because the transport sector, I mean, when nobody was flying, nobody was traveling, even, you know, for driving to work, everything has been curtailed. And as a result, we saw these massive dips in oil demand. For those of you who are not familiar with main data sources for energy, we use OPEC, the IEA, and the International Energy Agency, and the US Energy Information Administration. And you can see, although it's usual to have disparities in the numbers, but still a dip of 10% of oil demand disappearing overnight in 2020 is a major shock to oil markets. However, they seem to be expecting around 6% rebound in oil demand. However, just like the discussion on the economy, these numbers have to be put into perspective, because when you talk about 6% rebound, and again, you're starting from a low base, it doesn't mean that the market is going to go back to its heydays before COVID, but because, you know, according to current expectations, and again, they vary from one forecasting agency to the other, but there seems to be an agreement that we're not going to hit the pre-COVID levels anytime soon, though some are expecting that to change towards the last quarter of this year. But on average for this year, will not be back to the pre-COVID levels, at least not before 2022 in terms of oil demand. And this is the main missing ingredient, jet fuel. You see, in all, perhaps in all its applications, except transport, oil is facing competition. But in the transport sector, despite the talks about electric vehicles, oil remains king. However, when you stop people from moving, when you reduce mobility, of course, oil demand is going to take a big hit. And as you can see, this is the jet fuel demand, which is determined by commercial flights. And this is where we are at the beginning of the year, and the picture has not changed significantly. And this is where we were, let me see. So 2019 is the orange bar here, the variation, and this is what happened in 2020, and we're still not back anywhere close to the levels we saw 2019 or early 2020. Actually, today I think we are around 60% of the demand for commercial flights. Now, you may say that as soon as everybody gets vaccinated, life will go back to normal. But if you look at the vaccination speed, it is going well in some countries, but not that well in other countries. I mean, here in Germany, I am very disappointed by the speed at which vaccination is taking place. And it's not just about the developed economies. You have to think about the developing economies where vaccination has hardly started. So you don't want to be taking a flight to go to a country and then suddenly they enter into a lockdown. And other countries might say you're not allowed to come in before you get your vaccine done. So I don't think, we're going to see this changing drastically in the short term. I hope I'm wrong. But again, if you speak to various scientists, if you check all data, you see that to go back to the 2019 levels, we need to see the vaccination spreading at a much faster rate than when we are seeing today. That said, I have to say that when I looked at the recovery in oil prices, you can see this dip, and these are the monthly prices for both WTI and Brent. And WTI, it's mainly North America and the US, and I'll tell you why I'm showing both in a second. But typically, if you look at the evolution of oil prices in the industry for the last maybe 80 years, every time there was a big hit to prices and then prices collapsed, it took at least 18 months for prices to go back to their pre-crisis level. So it was between 18 and even 36 months for prices to go back to their pre-crisis level. But here the dip was so big, and yet the recovery, though it kind of stalled from June, I would say, to November last year. But look at what has been happening since December 2020. We can see prices climbing rapidly. And actually this month in March, they kind of exceeded the levels seen in February last year, and even the levels that we saw in January 2020, which are the prices that we saw pre-crisis level. So that by itself is impressive. Now, of course, a lot of the credit goes to OPEC Plus, which represents the largest group of producers, a conventional OPEC, plus some of their allies led by Russia, which came together in December 2016 to stop prices from collapsing further and put upward pressure on prices. And then again, in April this year, they announced a deal that would go over for 2 years. And in that deal, they announced historic 9.7 million barrels a day cuts that would last until April 22, but they would scale it down gradually. And now this is why I'm showing you both WTI and Brent, because for the first time in the modern history of the industry, a major crude marker goes negative. And I think, if I'm not mistaken, it was the 19th of April when WTI went negative. So that was something quite unprecedented in the industry. But really what you see, what has been driving prices, of course, we are seeing recovery in demand, in oil demand. We are seeing recovery in the economy. But I would say the main factor behind the current recovery in prices is OPEC Plus. I would add one more factor. What I mentioned earlier, the fear of inflation. So there is some new, it's not new, but something like an additional factor playing a role. When people fear inflation, when investors fear inflation, they kind of put their money in safe haven. And usually you would do it in property, real estate, you would do it in metals, precious metals, and you also do it in oil because it's easily traded. And that seems to be also supporting OPEC Plus, the impact of OPEC Plus on the market. But we're going to see, OPEC Plus has moved from having a schedule over 2 years to having these monthly meetings to decide what to do next. So this added also to an additional layer of complexity in the market, an additional layer of opacity in the market, and that is also contributing to the current volatility we are seeing. Now, I'm going to just quickly go through these ones for the sake of time, but this is what the expectations currently are. We're expecting like maybe a tight market simply that demand is so close to supply. There is no overhang, massive overhang of oil put in storage. But again, just to show you, this is the average of 5 years average of inventories, oil that has been put in storage. We can see that how much has been accumulated during the height of the crisis because people were not buying oil, they were not spending, they were not consuming. But they have been drained down to almost the 5 years average, so that is good news. But on the other hand, if you look at how much spare capacity OPEC Plus has accumulated, or OPEC, it is also record high. Now, why I'm telling you this, I'm not expecting you to know all the integrity details of oil market, but usually when you have high spare capacity from OPEC, we tend to see the upward pressure on prices being tamed. So typically, historically, you would see prices heading higher when the spare capacity is low. But in this case, you have around 8 million barrels a day of spare capacity that OPEC has to deal with it, or OPEC Plus as a group. And that kind of limits the upward side of prices. Then there are additional supplies that could come maybe from Libya, but even more the other wild card for the rest of the year, that is Iran, or maybe for next year, if Iran is brought back to this negotiation table and a deal is signed with the US, so we should not rule that out. But this is for me more interesting. If you look, because you see, as investors, especially private investors and also state-owned companies, they wait for the right price signal. Of course, there are other factors that come to play, but the price plays a very powerful role in affecting investment sentiment. And typically we tend to see, for example, as an illustration, this is an illustration of the rig activity. And the rig activity reflects that, that when companies start, you can see this kind of dip here in the world because companies stop drilling for oil. But then almost everywhere you can see that this started to pick up. I mean, look at especially, North America with Canada, with the US, the red line. It's picking up slowly but surely, which kind of reflect more optimism in the market. And if you look at the share price of oil companies, remember, only a few months ago, people were using the massive dip in share prices of oil companies to say, that's it. We have turned the page on oil, on oil age. Only now, these kind of predictions are proven to be premature because you can see how share prices of the major oil companies have also recovered with the recovery of oil prices. Now, that is on the optimistic short-term side. But again, I'm an economist. I'm not that interested in short-term changes in oil prices because, again, there are lots of factors that come into play, including investment sentiment and market expectations. And today, these expectations are moving, as I mentioned earlier, in a wide range of two extremes, and therefore you have volatility. But when you look back at the last 11 years, you can clearly see that we have actually entered what I call a low oil price phase since summer 2014. Before that, prices were hovering around $110 a barrel, and then they took a big hit in summer 2014. Although they recovered a bit, again, courtesy of OPEC+, but then they are not really back to their pre-2014 levels. And today they are even trading in the lower range. So this takes me to what I think, if I'm not mistaken, it was the CEO of Shell who was talking about lower for longer. And this is why people perhaps are talking about additional pressure on investment and on companies. But let's see whether that would translate into tighter supplies in the future and maybe a smaller market. In the longer term, again, there is the issue of oil demand peaking. Before the pandemic, there were lots of publication about when oil demand would peak, and this started to gain traction and interest, I would say, maybe in the last 5 to 10 years max. But there was no consensus in terms of when will that oil demand peak. We hit a peak, and when you hit a peak, then afterwards the demand would start declining and the market will shrink significantly. So what we did here, we took the scenarios of 2019 and the scenarios of 2020. And although people say that COVID-19 has accelerated the energy transition and that it brought earlier the peak oil demand, we did not see supporting evidence of that because we still saw big disparities in forecasts. Some scenarios may say, for example, if you look at BP, that they do have something called rapid net zero scenario, but it's not much different from what they had before the pandemic. And actually, at some point, you would see that between two extreme scenarios, there is a difference of at least 60 million barrels a day of oil demand. That is almost 3/4 of today's demand. So what I'm trying to say here is that even though talks about peak oil demand may have accelerated and became more intense after because of COVID-19, it doesn't necessarily mean that we are more certain today about when demand for oil will peak and the market will shrink. It's actually, we are as uncertain as we were before the pandemic, and nobody really knows when that will happen. I'll come back to the peak demand in a second because there's here an interesting lesson from COVID-19. That's what I use as silver lining. But interestingly, and I'll be very happy to share with you maybe in a week's time, a report that we're publishing soon based on a survey we did last year among global energy producers throughout the supply chain, from oil and gas to downstream chemicals and refineries and professional service providers. And one of the questions we asked them about their main concerns for the next 5 years and for the longer term. And ironically, oil price volatility, not surprisingly, remains in the top 3. And, you know, competition from alternative resources, source of energy become more of a concern in the longer term. But peak oil demand is in the bottom 3 concerns, which kinds of either there is the respondents were not really too much thinking about peak oil demand, or truly they don't really see it as a threat happening anytime soon. But this takes me to another interesting finding from this survey, is that that's why you should read all these kind of responses with caution, because we are influenced by external conditions and the prevailing conditions when people, for example, answered this survey. But for example, people also dismissed increasing taxation, a subject which is close to my heart. And it actually it scored in the bottom levels. However, fast forward a few months later, already in the US, people are talking about increasing taxes in general. But I personally think that the oil industry will take its share from higher taxes around the world, because typically when government budgets are squeezed, the main suspect that they turn to squeeze more revenues out of them would be the oil industry. And this is particularly favorable if oil prices are higher. So I've always argued when I was working with private companies, oil majors, that high oil prices actually may not be good news for the industry, because they attract the taxman one way or another. And that's why we talk about cost inflation in addition to that. So not only the cost of material and hiring people will increase, but there's also the cost of doing business in terms of increasing taxes. So the issue is much more complicated than simply saying higher prices, good news for the industry, bad prices, bad news for the industry. There are many areas that we should take in consideration. And this is why it's very difficult to tell for sure what is the industry's outlook in the next few years. And if you compare the various outlook, you can see how they are continuously revised all the time. Now, I promised in the beginning in my opening remarks to share some kind of optimism. And here is what I have to tell you. First of all, when you look back at the prices achieved last year, even though we call it a crisis like no other, but really oil prices on average were trading around the same levels as we saw a few years ago in 2016, for instance, when oil demand was much healthier. So that is something that we have to think about, that even under the worst crisis and the collapse in prices in April 2020, on average, the picture was not that bad. More importantly, and this is what I want to talk to you about, especially when we talk about the energy transition and oil demand destruction. Yes, we saw a staggering loss of 10%, which is almost 10 million barrels a day of oil demand disappearing overnight. But even in the worst phase last year, there was still 80 million barrels a day of oil demand intact. So yes, people focused on the dark side of the story, the loss of nearly 10 million barrels a day, but we kind of overlooked that even in the worst case, when everybody was not flying or not going to work, there was still a lot of oil being consumed. And this we should keep in mind when we're thinking about talks about peaking oil demand and then the energy transition. The other interesting thing I personally find from this COVID-19 crisis is that it kind of gave the industry a flavor of how the market will look like when demand actually peaks. And I don't think any sophisticated computer model would give them the same kind of understanding of market conditions at what they actually experienced last year. And of course, the wise companies would be the one who would take the lessons learned from last year to be better prepared for future scenarios when demand is expected to peak. So again, there is another way to look at the crisis and see it more as an opportunity for the industry to seize upon. And then finally, we also tend to overlook the power of technology. Here I refer to the digitalization. I mean, look at us. I am in different part of the world, and it doesn't matter. We're maintaining this kind of contact. So imagine if the crisis had hit in the pre-digital age, it would have caused a huge mayhem everywhere. But in the oil industry in particular, yes, you may think that they have a conventional business, but actually they are at the forefront of technological innovation and all the time bringing costs down. I remember when I was studying about the oil industry and I was reading articles and books in the 1960s, people would describe offshore deep water as unconventional operations. And today it's pretty normal to go thousands of meters below the seabed, below the seawater. And then today we talk about shale in the US as unconventional. I think people were premature in their judgment last year when they wrote off shale because they felt that shale took a big hit and it would never go back. But actually today they are already talking about how quickly and how much more shale production would increase. So that's something, again, that we should keep in mind when we are doing these forecasts, because technology is often difficult to capture in terms of impact when we're looking at the next 20, 30 years. Now, in my conclusion remark, I wanted to bring in this connection between the industry investment and the energy transition. One thing that you noticed after the COVID-19 hit, one after the other, particularly European energy companies, started to make very bold announcements about changing their portfolio, investing more in green energy and less in oil and gas. And I think BP is leading this kind of march of the industry to change its look. But I want to take you to, and if you have the chance, to read a paper by the IEA, the International Energy Agency, a report which was hijacked by COVID-19. It came out in January 2020. And the report looked at the investment or the capital spending of oil companies, private and state-owned alike, on projects outside oil and gas, and especially in renewable, in green projects. And they said that between 2015 and 2019, so almost like 5 years period, less than 1% of the capital spending of these companies went outside projects which are their bread and butter, mainly oil and gas. So if you look at this speed, and again, I look at numbers from Wood Mackenzie, people talk about the need for $350 billion of investment in solar and wind required for the oil majors to achieve the same market share they have in upstream oil and gas. And that figure actually amounted for only $15 billion. So it's really a far cry from what is needed. And the question today, when you think about the capital is constrained, great volatility, great uncertainty in the market, where will all that money come from? And the risk of higher taxation. So this raises many question marks about the green agenda of these companies. And perhaps this explains why not all investors are buying into the green agenda of oil companies. So there's something to keep an eye on, but there is definitely currently a certain degree of skepticism because of this kind of data. But then if I leave the industry aside and the energy transition, there is my own worry about something that will become of a bigger issue because of COVID-19, and that could slow down, actually not accelerate the energy transition. That is rising income inequality. Before COVID, already that income inequality in many parts of the world became so strained that even slight changes in taxes triggered unforeseen reactions. You may remember the riots in Paris, in France, the Gilets jaunes, riots in Latin America, I'm not mistaken, it was Chile, and then in Iran, and then elsewhere around the world, wherever governments tried to make fossil fuels more expensive so that they would justify, for example, or support the development of renewable energy, we saw a massive reaction of people, especially where you have high income inequality. Now, today with COVID-19, because of the big hit that economies around the world took, and because of the massive debt that you face, not only in the rich world, but even more so in the developing economies and the poorer economies, the issue of income inequality will become more pronounced in the coming years. So again, that could be a major hiccup, in my opinion, to pursuing a more expensive energy transition unless technology brings the cost of the greener energy down further and significantly. But again, anything which has to do for more than a year from now, really treat it with cautious. And these are books that were published at the beginning of this century, where lots of publications were about how the world would run out of oil. And here they were referring to the peak oil supply and how nations were going to kill each other just to gain access to this valuable commodity, which is dwindling. And then 10 years later, they discovered that they could do better without any of these books. So really, especially today with COVID-19, what happened to us last year confirmed what many politicians tell us, especially the late Margaret Thatcher, to expect the unexpected. And all these forecasting models may be proven wrong if this concept of past dependent theory is proven right. And COVID-19 may have opened many new paths that we are not able to understand yet. And on that, I thank you very much for listening. And I hope I did not complicate your life with all the bits and pieces, but life today is pretty complicated. Thank you for listening.
Thank you, Carole. Thank you very much for your talk. There are several questions, so if it's okay with you, I would like to go directly to them because we have a few. Nicolas asks the following: the mandate for home office as a work modality caused many companies to choose this method as permanent. Does this modality contribute to the delaying of the return of oil to average values?
Sorry, I missed the first part of the question. Is it written? Then I can hear it.
The first part, what Nicolas wants to know, is whether a home office as a permanent modality may be delaying the return of oil to average values.
Yeah, sorry, because when people talk about the home office, I live in the UK, we talk about the government body called home office. That's why I did not hear properly the question. Well, look, I mean, definitely, people seem to be adopting a new way of working, that is working from home. And I don't think this is going to disappear anytime soon because it brings in more flexibility. It gives people greater freedom to be with the family, especially when you don't have childcare. And also it has been facilitated by digitalization, technology development. However, there are big question marks to what extent that would become more structural when it comes to doing business. And the reason I'm saying that is because of the following. And again, it's in the report that will come out soon. I will share it with you. First of all, ironically, a couple of weeks ago, when people could go back to work here in Germany, I saw my neighbor with a big smile on her face and she said, finally, I'm going back to the office. So not everyone, I mean, definitely there are more people who want to work from home, but this doesn't apply on everyone because they feel that, the work-life balance has been seriously distorted. There's one point to consider. The second point is the risks, the cybersecurity, cyber threats. People seem to be downplaying that risk because when you are in a company, everything seems to be shielded. Everything is brought down to the IT person and you don't have to worry about it. But when you're at home, you don't have perhaps the same systems for security that you have in the office. And the oil and gas industry is an easy target because of the importance of oil, because of the value of the business. So if these become, and you don't hear about them, not because they are not happening, but because companies don't talk about them. So that could also place obstacle on having this kind of home office to become more permanent or something more structural. And then finally, interestingly, it's raising a new dimension that would be something for HR people to resolve. When we work from home, we tend to overwork. We don't realize that, but this kind of boundary about the working time that you spend in front of your computer, even the posture that we have. I mean, look at me, I'm sitting on an old bench here and I don't concentrate on my posture. So these are small things that we can tend to overlook, but they will cause some headache for companies, and companies might think that, oh no, hold on a minute, this is not working. So I'm highlighting these issues because it's not easy just to say, okay, working from home, you connect to the computer and everything's going to be fine. Yes, it's transforming, perhaps moving a little bit away from the conventional, but to what extent it will become more permanent and structural, again, it's something that we have to wait and see, but it will cause some problems along the line that companies will have to address. And it's not just the oil industry, but all companies that are following this kind of practice.
Thank you. I'll merge a couple of questions that I think go in the same direction. Sylvia made a comment that Shell, for instance, is like consolidating its operations due to the low profitability of the downstream. And Giancarlo asks the following two things. Do you think that refineries should be investing in flexibility projects to shift from combustibles to petrochemicals? And he also asks, what have you read about hydrogen as a potential game changer?
Federico, just the first question from Sylvia, who was doing more consolidation?
Sylvia, it's a comment that Shell, the Shell company, the Shell is doing consolidation of its operations due to the low profitability.
Yeah, I mean, definitely you see, and it's not just Shell, but lots of companies that they are revisiting their portfolio. And when I share with you the slide, you will see, I think somewhere where I mentioned, I may have included this one or not, but you will see that consolidation of portfolio, revisiting the portfolio so that you meet a certain threshold of rate of return, certain threshold of acceptable return for the shareholders, for the company. This is not surprising, and it always happens when you have this kind of environment, at least oil price environment. So this is pretty expected. And in my opinion, consolidation is healthy. So if you look at, even if I look at the shale industry in the US, the reason why I did not subscribe to the end of shale, even in its worst moment, is because of this wave of consolidation, which allows usually the healthy companies or companies which have a stronger financial position to kind of also take over the assets of those that are not doing so well. So I would say, consolidation for me is like revamping, getting your house in order, and then emerging from the crisis stronger and leaner. It happened before and will always happen when you have this kind of price shock and the right signal from the market. And actually, high prices, I mentioned earlier, are not necessarily good for the industry because they kind of loosen discipline. And also for governments, when they want to pursue reforms, they would do that during periods of low prices, but not during high prices. Anyway, that's a different discussion. Regarding the flexibility of refineries and moving more into petchem, that is definitely happening. And we can see that with refineries, and refineries took also a big hit. Ironically, usually in typical oil crisis, what we see if in one company, let's say, which has operations in upstream, midstream, and downstream, if oil prices go down, then upstream suffers, but let's say downstream benefits because the demand has been safeguarded. But here, what you have that both, throughout the supply chain, everything got a big hit. But a combination of low profitability, but also the impact of technology, digitalization in particular, and as well as the green agenda is pushing refineries to adopt a more, you also look into their portfolio and diversify and turn more into flexibility and adopt and moving more into petchem. In terms of hydrogen, I'll keep it here very brief. We see that hydrogen is getting a lot of attention, but let me tell you this. More than 20 years ago, when I moved to the UK and I started working on energy, one of my colleagues told me to try to focus on hydrogen because that is the future. And today I understand the big interest in hydrogen, but when you speak to scientists, you can see that we're not quite there. And if I focus, for example, on the Middle East, there you see big oil producers, the UAE, Saudi Arabia, and Saudi Aramco. They are announcing big projects and ventures in hydrogen because for them, it kinds of build on their massive oil and gas resources, and it allows them, to take advantage of the existing infrastructure, etc. But right next door, Qatar, which may be perhaps better positioned than these countries because of their gas resources, they openly said and clearly said that they will not invest in hydrogen until the technology is proven. So you have neighboring countries, almost similar potential, but saying completely opposite things with respect to hydrogen. I think today, that if the technology is still, we're not there to talk about hydrogen being competitive. There are lots of hurdles with respect to the technology and its wide application, but there is interest. And maybe that will materialize, but I don't see it making a huge difference, at least not in the next 5 years.
Thank you. I have 3 more questions. I'll try to keep it there, but we want to pick your brain for a while. Gabriel, you mentioned this, but Gabriel asks like a follow-up question regarding you mentioned that maybe oil prices will not go that high, that there is, when there's fear of inflation, people go to oil to a certain extent as a safe haven. But what Gabriel brings to the conversation is the rate of dollar printing, particularly US dollar printing. And if you think that could even become like a bubble similar to the .com 20 years ago or something like that, there are also, and I am adding this, there are also talks of this commodity super cycle that we may be facing. What's your view about that?
So that's one question or several questions?
1.5.
Okay, sorry, I'm not, treating all questions fairly. But first of all, I tell you where my suspicions are with respect to the commodity super cycle. And again, I may be entirely wrong, because really, if I wish I included a slide showing the global attempts to forecast oil prices, I think you'd be better at forecasting the weather than at forecasting oil prices, because oil markets are big and much more complex than people realize. Now, why I'm saying that? Because let's assume prices, if one of the slides I showed earlier about where we are today, the low oil price band since 2014. And actually, if you see, despite the fact that we have historic production cuts, now more than 7 million barrels a day, you can see that prices, yes, seem to be marching upward, but something seems to be keeping a lid on prices from going crazy. So on the supply side, you have risks, downward risk. Outstart, yes, I mentioned Iran and Libya. You might say this may not materialize, and I agree with you, it's highly uncertain. But what about production from outside OPEC? Already, again, that data I showed may not be up to date about the rig activity, but if you look at investor sentiment across the industry, they are getting ready to start putting more in the industry. And shale usually is the first one to leave the market, but also the first one to come back to the market. So higher prices will simply translate on the supply side into additional supplies. And that's what has kept the lid on prices of the last few years, despite the mammoth effort of OPEC+, which originally, for your information, it came together for 6 months, but the challenge was so big that since December 2016, they continue to be around. The second factor is on the demand side. I know here maybe this may not be a major fear at the moment, at least not in the rich world, but you can, when you are going through a fragile economic recovery, especially if you are an oil importer and oil takes a big chunk of your import bills and you're paying a lot, the last thing you want is higher prices that would weigh down on your economic recovery. And the Indians, for example, are one of the major oil importing nations. They are making this kind of noise, and they are complaining openly, actually, about the price level that we are seeing today, that this could derail their economic recovery. So that's why on both the supply side and the demand side, yes, we may not see, I'm not saying that prices will collapse, but we see that prices seem to be, yes, taking over, but they are not going to overshoot because of these two forces that would exercise pressure in the opposite direction.
Thank you, Carole. And now the 2 last questions. I'll start with the first one. And again, thank you very much for your time. It's from Guillermo. He would like to know what you think about the growing importance of the ESG funds and its impact on the oil market in the near future.
All right. ESG, environmental, social, and corporate governance. Again, it was one of those things that became very popular before COVID-19, and people fear that it will direct investors' capital or money, so they would go and put their money in companies and projects which score high on ESG and move it away from companies that score low on ESG. Now, even before the pandemic, the main issue is really identifying or quantifying how much of the investment decision is being influenced by ESG factors. Now, so far, the overwhelming evidence supports that investment is still driven by the old-fashioned rule of achieving high rate of return. So when I mentioned earlier about the decline in the share prices of companies and the kind of disconnect, even when prices start to recover, share price of oil companies took a while to respond to that. It's not because of ESG, because today share prices are doing pretty well compared to last year for oil companies. It was mainly investor sentiment with respect to future oil prices. So in 2020, they expected, they were not confident that prices would recover, but today that sentiment has changed. And then you wonder, okay, so where does ESG fit into that? Interestingly, we looked at ESG for 2020, and we found that it took a hit. That it was not really as a priority as it used to be, but there is a belief that this is not like a permanent hit, it's just a temporary hiccup because of COVID-19. But I would say that based on discussions we had with some people from the financial community, the way they look at ESG today is more, for example, if they have to choose between company A and company B with similar financial performance, they would then use ESG score to decide where to put the money. But it's not going to be like putting your money in ESG score, even if the financial return is very bad.
Thank you. And last, but definitely not least, a question from Jose Maria. He wants to know, what do you expect in the oil exploration field? Do exploration professionals like geophysics should move to another resources like geothermic?
Well, look, I'm not a technical person, I'm an economist, so I don't know the technical terminology. But interestingly, exploration before COVID was taking a hit. So if we look at the rate of discoveries, they have not been as impressive as before. And there are several reasons for that. But today, of course, with oil prices where they are, exploration, because this is where you have the highest risk in terms of gambling your money, because really it's like gambling. Even with the best technology, you're still not sure. But I would say that companies would be more cautious. I come from Lebanon, for instance, where people were expecting a big bonanza because of oil and gas, but we find that companies suspended their activities there for several reasons, but they drilled a well and it turned out to be unsuccessful, but it kind of dampened their enthusiasm. So usually when you have the current oil price environment and capital spending takes a big hit, usually you don't really cancel projects which are ongoing. So if a project is through the development phase, you don't go and cancel it. You usually cancel or delay projects that are in the pre-development phase. And this is where we talk about exploration and appraisal. So exploration will suffer from this. But again, here I want to bring in an interesting dimension, which we did not discuss, but that deserves a completely entire discussion, separate discussion. That is the power of government policy. So even if because oil price is, the exposure is the same everywhere. But if governments revisit, for example, their licensing policy when it comes to exploration, or they look at certain incentives, for example, they can actually reverse the kind of impact of oil prices. So it's not just a clear cut. It can vary from one country to the other in terms of impact on policy. But where they should direct their effort, I'm sorry, I will not be able to advise. I don't want to pretend that I know the jargon of geologists and explorationists.
Carole, thank you very much for your time. Would it be possible that we share your presentation with the people who enrolled?
Oh, definitely. I will share the presentation and also share the report that I mentioned about the expectations, the kind of perception in the industry as soon as it comes out. But I will send you this presentation very soon.
Fantastic. Thank you. Well, and thanks to everyone who joined for this webinar. And thanks again to Fundación Cívico, Republicana and Club de la Libertad for partnering with us, Somos Innovación, to organize this. Carole, thank you very much for your time. We know it's late for you, and we really appreciate it, and we hope in the future we can have you again.
Thank you very much for having me, and I wish you a very good day or very good evening wherever you are.
Bye-bye.
Bye-bye. Take care.